Thank you. Thanks for that. Then it's a pleasure to be here. From what I know so far, I think Eve is probably a good idea for us. But before really coming into that, and with maybe some questions on it as well, I want to give you a little bit of an introduction to what insurance and reinsurance really is, and how we think, and how we work. Okay, on your left side is risk a product. Risk as a product, the uncertainty of the insurance business lies in the fact that the cost of goods sold is not known at the time of production. That's really our issue, right? So anything we really do has to do with modeling. So our entire products, whatever it is, as it is risk, is based on modeling, and modeling the risk in different ways, right? On the right is simply because Daniel Ellsberg just died a few weeks ago. I thought I'd bring that up, and the Ellsberg paradox, which is essentially people love anything that is understood and modeled, right? And rather prefer that to something that is probably of lesser risk, but it's not quantified, right? So this ambiguity aversion is another thing that might help Eve going forward. So what is the insurance world? I would want to put you into our shoes. So think about you're the manager, right? You're sitting here and stand on the first desk on management. Our idea is strategy is growth, is return on capital, right? But also return on our assets. We have an asset side and a liability side in our balance sheet. To our right, or rather start in front, right? Opposite to us is our client. And our client, that can be you, that can be some investors, well, there can be some other people that have risk, right? The idea there is to reduce the performance volatility, and for most of you who might have homes, right, to protect your equity, because your home might be your largest equity. On the right side are the investors. Most of our companies are essentially listed in one of the stock exchange, and the investor wants to get their return on investment. On our left side is the regulator. And the regulator is quite important for the insurance industry, and the regulator cares mostly about the fact that after a big event, you need to be able to get our money from us. So therefore, they look into how much capital do we have that sits against that risk. And with that comes the so-called solvency ratio, and a solvency ratio is normally twice the amount of capital you technically need. So there's a kind of a load on top, just a security load that sits there just to make sure that we are able to pay if there's a big event. So our industry is actually very small. There are certain reasons for that. So we have overall the order of 9,000 companies or so around the world, and then reinsurance is the arm that insures insurance. There are several reasons why we need reinsurance, and one reason is that a lot of insurance companies are too small. Therefore, the risk curves are too steep. They would need too much capital, which would be inefficient. So they go to reinsurers that can diversify that away, because they are most of the time global, and the capital cost becomes relatively much smaller. And then there are hybrid companies that include both insurance and reinsurance, and that's quite a lot of companies, especially on the reinsurance side. Capital is only 2 to 3 trillion, right? That sounds large for you, but if you look into many other financial markets, it's actually a small market. And on the reinsurance side, it's only 600 billion. And the premium side is not that far away from that. Actually, we need more capital on the reinsurance side than we need or can get premium. Whereas on the insurance side, it's roughly the same amount. And then our stock multiple is relatively small, simply because we are highly regulated, and therefore we cannot create, by definition, a lot of profit. And the cost of capital sits, depending on the jurisdiction or the territory, somewhere in the order of 5% to 15%. Okay, now look into the world of products. And we start on the if you first floor here, and you see the different desks, again, the management, regulation, clients, investors. But around that, you see the products we really have. So on the top right is the natural catastrophes. On the bottom right left is the man-made catastrophes, and there is directors and officers, the D&O, aviation, crop, energy, right, casualty, accident and health. There are quite a lot of different areas around risk we actually insure. And then on a second level, which is indicated by these shadows here, is actually where the systemic risk comes in. So the second dimension is a dimension of systemic risk. That means risks we cannot easily diversify away, right? And what comes into mind here is clearly war, because war can easily be global, and war is actually only in a very small part really insured by the insurance and reinsurance industry. Some marine business, for instance, include war. Then there's pandemic, again, another issue, because at the same time you can have losses everywhere in the world. Cyber risk is another reason, or another line of business. And then climate change as well. And it's on the climate change side, it is really the change that is systemic. And so as we look into climate change largely as an uncertainty, it's the correlation of uncertainty in our models that is a challenge here. So it's essentially things can go worse in many areas in the world at the same time. It doesn't mean we necessarily have a lot more of hurricanes, but it means that the change that is there overall creates a systemic risk for us, which creates a lot of issues in our models, in our understanding of risk, and a lot of question marks. Okay, I said our market is very small. There is a reason why this market can be small, and that reason is probably very distinct for our market. That is, we can truly diversify risk. So once we are a rated entity, which means there is a body who essentially gives us a certain credit rating, once that's all done and we regulate it, we can diversify capital in the way that I can use the same US dollar for an earthquake in California, an earthquake in Japan, an earthquake or a windstorm in Europe. So the very fact that we don't expect that these happen at the same time allows me to diversify risk. That's very different to the normal capital market that needs to hold capital wherever they take risk, for the simple issue that it can be systemic in the tail. So, and that really means with reinsurance covers most of the catastrophes finally, because insurance puts that into reinsurance. So 600 billion around the world takes care of all natural catastrophes, essentially. There's a little bit more to it because there are a few other markets that help. Nonetheless, if you look into the US alone, and if you simply look into capital stocks, simply the buildings there is already 75 trillion. If you look around the world, not even including infrastructure, we sit at 280 trillion. So 600 billion covers essentially at the end of the day in the order of probably 500 if we take the infrastructure to a trillion of exposure. And that's surely the issue why systemic risk is an issue and is something we need to better understand, or at the moment we try to avoid as much as we can. Okay, the opportunity is relatively clear. If you look again on the right side, at the moment we see in the order of 100 billion every year of insured loss. That is roughly equivalent to 350. The numbers are a bit different because that surely is something that is a little bit more difficult to understand. Nonetheless, 350 billion of economic loss. So there is a large, what we call insurance gap. The insurance gap on the western side is still in the order of 50%, or in other words, only 50% is insured because the infrastructure is largely not insured, and that's roughly 50%. So there's a lot of possibilities in climate change, for sure, and one is, of course, related to increased awareness. We could increase, essentially, what we have in our covers, make it bigger according to that. Investment in risk mitigation can help regional sovereign climate products and so on. Litigation, innovation, new products, right? There's a lot we could do also related to what we call climate change products, which are parametric products, which leave always some what we call basis risk. So we would have what we call indemnity, so the direct payment of the actual losses along with parametric. Parametric alone most of the time doesn't work, but nonetheless as a package it can work, and so on. At the moment, a lot of insurance and reinsurance companies try to avoid covering a lot of that. Actually, we see more and more companies saying we cannot insure natural perils anymore because the risk is going up so much, right? So by better understanding it, eventually disaggregating to a certain degree, so not lumping everything in one policy, more doing it structured, I think we can do much more. And then public and private projects will surely help, and so on. We could include climate directly in some of the products in a much better way than we do now. Don't want to go too much in detail. But if you compare that to cyber risk, you might be already wondering that cyber risk or the cyber economic losses are already larger than the natural catastrophe losses we see. So we're talking now already about in the order of 4 trillion of cyber losses, economic losses. And here the market, the insurance gap is much, much larger. The market has a premium roughly of 10 billion. We're talking about average losses of 5 billion. So 5 billion to 4 trillion. So we're more than 10 times already on the cyber losses to the natural catastrophe losses. Okay. Climate change risk is for us a wide field, and it includes both the physical and transition risk. I don't want to go too much in detail on all these parts, but probably what is important, and you understand what the physical is, the transition risk, right, has a lot to do with one thing, for instance, what we call social inflation. And interestingly enough, in most markets, people don't understand social inflation in the way we understand it, but social inflation is essentially litigation funding. So what is currently happening in the US is that there are big funds set up in order to make money on litigation. So in order to influence the jury, in order to make the payout as large as possible, and then give some of that payout into certain funds that have invested into that. Which sounds probably for a European quite strange that these things happen, but that is increasing losses threefold in some areas. So if you look into some simple example, pregnancy, a miscarriage, 10 years ago in US, maybe 2-3 million. We're talking now about 70 million for something like that. And a lot is going into different pockets. So that's a large issue we have to work with. And if you look into this transition risk, which has a lot of other things included, one could be that in the future, those who cause climate change could also be asked to pay for it. And we already have in our D&O policies, we already have parts of that covered. So that could be a very significant loss coming into the market. And then of course regulation, understanding, or thinking to understand that risk is going up very significantly, we need to hold more capital is another part of the transition risk. So we think until 2050, right, the physical might go up 1.5, I don't know, difficult to say, we can discuss, but we think the transition is probably much more than that. Okay, what we do in our market is a lot of modeling. Don't want to go into detail, but at the center of each company is what we call an enterprise risk model or an enterprise risk, an ERM platform. And in that platform, we try to model all risks we have in the company. So that includes liabilities, that includes the assets, that includes the correlation, you name it, between casualty, property, financial risk, political risk, we cover political risk as well, and a lot of specialty lines and so on. And a lot of these lines of business will be affected by climate change. I didn't put cyber into that area, although I think there are a lot of reasons why cyber will be affected by climate change as well, because of several interactions that sit there. But that is really the core of what we're doing. We try to model everything, right? And when we talk about modeling, we need to hold capital to a certain level, right? Which is, for those who are modelers, know what the TY is, the tail value at risk. We integrate over a tail. Sum there at the 1 in 100 times 2 is roughly the capital what we need to hold for all risks we have. If you look into the recent years, it's quite interesting, and a lot of people might not know that actually hurricane risk was incredibly low for quite a number of years. If you look between 2006 and 2016, the hurricane risk was actually very low, despite the fact that now we see a lot of hurricanes again. So that created a market where the price went down quite significantly, and we created losses that were larger actually than payout. And in the last year, this has changed again. So since 1/1, the prices went up by an incredible 30%. Another quick thing that often people confuse losses with hazard. And we've seen a lot. You've seen from companies I don't want to mention here, you've seen numbers where it seems that losses are going up massively. We have a lot of climate change, but in a lot of areas, losses didn't necessarily go up. Some areas they did, and some others they went down. But if you look, for instance, here on tornadoes, if you look into losses, it looks as if losses went up massively. The hazard didn't change, just the opposite. If you look into the more severe tornadoes in the US, actually the numbers went down and not up. There seems to be quite significant trends in that. But the losses went up simply because the penetration goes up, because our exposure goes up, our vulnerability changes, and with that, the losses change significantly. That doesn't necessarily mean the hazard does that. Okay, one, as we don't have much time, on the modeling side as well, right, we still make this kind of mistake that we think risk is hazard times exposure times vulnerability. That was many years ago. Let's go away from that, because these boundaries, these transitions between hazard and exposure, right, and vulnerability doesn't make sense, right? We focus ourselves into a certain transition, which we don't think is the right thing to do anymore. So we need to integrate over that area. And a simple example is what I would call the Slobodans pot here, resilience pot. So the intensity is that red arrow. That's really what we model at the moment. So there's a certain intensity, which then with vulnerability and exposure creates a loss. In reality, all that pot is the development of that loss over time, depending on all the things you put in, claims management, in rebuilding, and so on. That's the area we really need to model. We need to model the system, and don't think that intensity finally equals loss. And if you look into what we do at the moment, right, 90% of our cost goes into this first hazard pot. And only 10% goes in the rest, but it's 50% of the loss. Okay, and that really comes to my final comment here. I think, you might disagree, I think if we would be able to take Eve to the next level and integrate that into a full resilience system of system model, that would surely help us much more. And I think at the end of the day, would bring a lot of acceptance further into the market. That is a much wider area because we have to do much more for that. But I personally think this is where Eve, at least for us, need to go in to be truly beneficial for our market. And I think with that and Ellsberg's paradox, right, especially with climate change, if we can model things better, I think the acceptance and the ability to insure it will increase massively, and I think we can create a solution, at least from our side, to that issue. Thank you.